By May 2026, Amazon operates with a market capitalization of $2.56 trillion. To maintain that valuation, the company is currently executing one of the most aggressive capital cycles in modern corporate history. To understand exactly how aggressive, we have to look at free cash flow. This is the capital left over after a company pays all its operating expenses and capital expenditures. It is the ultimate measure of corporate liquidity. This chart tracks Amazon's Q1 2026 profitability. The green line represents net income, surging 42.8% to hit a record $30.3 billion. But here is the paradox. Over that same period, free cash flow collapsed by 221%. It drops to a negative $18.2 billion deficit. A sudden $18 billion hole in liquidity would signal a catastrophic operational failure for almost any other business. For Amazon, it is a deliberate, highly calculated reallocation of resources. We are going to conduct a rigorous, fundamental analysis of Amazon's balance sheet to reverse engineer this deficit. We need to track exactly where that cash went. To understand Amazon's true valuation, look past the missing cash and look at the physical infrastructure being built to support the artificial intelligence frontier. First, let's establish the baseline scale of this economic engine. In fiscal year 2025, Amazon generated $716.9 billion in total revenue, yielding $80 billion in pure operating income. This waterfall chart illustrates what happened to that massive cash generation in Q1 2026. A record-breaking $44.2 billion was siphoned directly into capital expenditure, or CapEx. Breaking down that red block reveals the specific targets. The first major drain is a strategic investment in Anthropic worth up to $25 billion, which is directly tied to a massive 5-gigawatt computing capacity reservation on AWS. Right next to it is a $50 billion partnership expansion with OpenAI, accompanied by an additional 2-gigawatt capacity commitment. Facilitating both of these massive data deals is Amazon's proprietary silicon. AWS custom chips, specifically Trainium and Graviton, are now generating a combined annual revenue run rate of over $10 billion on their own. The cash drain extends into aerospace. The final major capital sink is Project Leo, Amazon's aggressive expansion into a low Earth orbit satellite network. Project Leo integrates directly with emergency SOS messaging systems, securing Apple as a long-term anchor partner for the satellite network's bandwidth. Amazon is taking the liquid cash generated by its retail operations and converting it directly into hard infrastructure. They are systematically locking in the physical hardware required to run high-margin computing monopolies. This raises a structural question. How does a single corporation absorb a $44.2 billion quarterly CapEx hit without triggering a debt crisis? The answer lies in their capital structure. Amazon holds $101.8 billion in cash against its long-term debt, supported entirely by 10.76 billion outstanding shares. That massive share count is the result of historical stock splits, specifically the sequence of 2-for-1 and 3-for-1 splits that Amazon utilized to maximize liquidity through 1999. This dual-axis chart visualizes Amazon's defining capital return policy. As retained earnings climb steadily higher, the dividend payout remains a flat line. They pay $0 in common stock dividends, have never paid one, and publicly state their intention to retain all future earnings. Because of this persistent 0% growth rate in dividends, Amazon is entirely excluded from traditional income-focused portfolios like the dividend aristocrats. Yet, as you overlay their historical market capitalization, the lack of dividends clearly hasn't deterred investment. The valuation climbs directly alongside those retained earnings. Institutional investors accept zero shareholder distributions because Amazon's internal return on invested capital in AI and AWS vastly outperforms any theoretical dividend yield they could pay out. While the capital goes into digital abstractions like cloud computing and AI, the cash is generated by an intensely physical operational engine. The global workforce required to maintain this physical footprint expanded from 1.29 million people in 2020 to roughly 1.55 million employees today. Demographically, this global workforce maintains a gender distribution of 56.8% male and 43.1% female. In the United States specifically, the logistics network is driven by a diverse base, with white employees comprising 31.9% of the workforce and black employees making up 26.1%. The internal distribution of this labor force is highly skewed. 65% of all personnel are dedicated entirely to physical operations and fulfillment, compared to just 15% working in AWS and technology. Recently, Amazon began aggressively optimizing this structure. While the blue-collar logistics base remains vast, the company strategically cut 14,000 corporate managerial positions to drive down white-collar overhead. Simultaneously, they integrated over 750,000 robotics units into their fulfillment centers. Those machines now process 75% of all customer orders. This is the strategic friction at the center of Amazon's business model. They operate a vast, low-margin physical logistics army to generate the raw cash flow required to subsidize their lean, high-margin cloud ambitions. Let's return to the 7 gigawatts of computing capacity Amazon reserved for Anthropic and OpenAI. Running data centers at that scale places an immense, sustained electrical strain on local power grids. To mitigate the operational risks of that energy consumption, Amazon aligned its logistics and data infrastructure with the United Nations Sustainable Development Goals 7 and 13, focusing on clean energy and climate action. By 2025, they achieved a major milestone, matching 100% of the electricity consumed across their global operations with renewable energy sources. They crossed this 100% renewable threshold a full 5 years ahead of 2030 target set by their own climate pledge. To reach that scale, Amazon executed over 260 active projects in Europe alone, making them the largest corporate buyer of carbon-free energy on the continent. In parallel, they are actively decarbonizing the physical logistics network, pushing to deploy over 100,000 electric delivery vans onto the roads by 2030. Achieving these ESG targets serves a highly practical corporate function. Controlling their own renewable energy supply builds a defensive moat, insulating their massive AI infrastructure from future grid volatility and the financial threat of regulatory carbon taxes. To conclude this fundamental analysis, we have to evaluate Amazon's position against its mega-cap peers. This matrix breaks down the competitive landscape across e-commerce, cloud infrastructure, and AI. Amazon competes directly with Microsoft Azure and Google Cloud. When you introduce retail competitors like Walmart, you see their physical e-commerce dominance, but a complete absence in cloud and AI infrastructure. Even benchmarking Amazon internationally against conglomerates like Alibaba and Tencent reveals similar limitations in scaling both sides of the business globally. This is Amazon's dual-engine advantage. None of their global competitors possess both a dominant, cash-generating physical retail network and a Tier 1 cloud infrastructure. At a $2.56 trillion valuation, the fundamental health of the company rests entirely on maintaining that dual structure. Which brings us back to the opening paradox, an $18.2 billion free cash flow deficit in the middle of a record-breaking profit cycle. That negative cash flow is a feature, not a bug. By sacrificing short-term liquidity and withholding dividends to buy data centers, custom silicon, and satellites, Amazon is permanently widening its competitive moat for the generative AI era.